Hello, everyone, and welcome to the Property Trio. It's market update time, and we're very excited to unpack the numbers. Some interesting movers in this one, and as always, I'm joined by the two wonderful co-hosts, Dave Johnston and Cate Bakos. Hello, guys.
Hello,
Morning,
Mike. How are you?
Doing well. I'm excited to see what we've got here. The index results as at the 31st of March, a bit of a mixed bag, but there's one particular one that, we did flag on a previous episode deep dive, Darwin, that is galloping away. Everything else, it's kind of like, things are on the downturn. Melbourne's not necessarily showing what we seem to be feeling on the ground. What's the takeaway from you guys for the month in those headline figures?
Wow. What were we talking about just moments ago off air? And it's the contradiction of other data sources. And of course, data integrity is something that we care deeply about. But CoreLogic, they've got Darwin absolutely screaming with 1.6% growth in 1 month. That's huge. And it overshadows everything else. I mean, Perth is less than half that at 0.7, and that's the next closest. But interestingly, PropTrack don't have Darwin as number one. So it is something that has us, scratching our heads about in terms of how they collate this data, because Darwin's registering as 0.3% growth for the month of May, and Melbourne is leading the pack with 0.8. So I know I've just introduced a completely new nuance to our show, but I think we've got to put it in perspective and accept that there are, a couple of data sources here that aren't quite agreeing with each other this month.
I think the Melbourne number seems more correct and the Darwin number seems more incorrect from a PropTrack point of view, just from an anecdotal point of view. But it does kind of highlight that there are obvious methodology differences. We know that the Hedonic index is something that CoreLogic uses, which considers like for like. So it's not just a house, it's looking at the number of bedrooms, and there's probably a very sophisticated algorithm that helps them get to an end number. How PropTrack does it, and to be honest, how CoreLogic does it to the minute detail, is a complete mystery to me, and perhaps it's a mystery to anyone that's not on the inside. Maybe that's part of their intellectual property, and we couldn't even get someone from one of those data houses to explain it to us.
Yeah, I think what is really interesting is that contrast, isn't it? I don't recall seeing such a large contrast previously, particularly the Darwin one. I mean, if we look at CoreLogic, that's 3 months of a 1% or above growth for Darwin, 1%, 1.1, 1.6 in the last 3 months. That they did have it at negative 0.1 in February, whereas PropTrack, which is backed by realestate.com.au, which is, the largest property databases really in the country, it only has had Darwin at 0.3, 0.2, 0.3, but in the last 3 months. In February, it did have it at 0.3, so that was actually above CoreLogic for February, who was minus 0.1. So arguably that smooths it out a little bit, but it's still miles below the 1% or above growth that CoreLogic, or what's it called now, Cotality, has had for the last 3 months. So it's a hard one. You just don't often see distortions or differences so large between two of the major indexes, do you?
No. One thing I did wonder is whether the collation of data with PropTrack is just hinging around what's on REA and ignoring any data that goes through other search engines like Domain. And I know certainly, Sydney and Canberra are not REA centric like Melbourne is. So I wonder if that's a possibility as well, or whether it's a sweep from Valuer General data and it's cut differently.
That's a really great point. I mean, if that's the case, and we've heard anecdotally and from buyers agents that there's a lot of properties being sold off market before they can even list in Darwin over the start of this year, as the market's been flying. And if it hasn't been passing through the realestate.com.au database and they've been missing those sales, it's a very logical explanation for the difference.
And anecdotally, I have been hearing that there's a lot of off market in Darwin, and then you add the fact that it's only roughly 150,000 people, right? So any amount of heat can disproportionately kind of impact those prints. But it kind of begs the question: if that is the methodology of prop track, then they're going to be closer to the pulse. Whereas if they're waiting for valuer generals, then it's beholden to the settlement period, which is going to be 90 days or thereabouts, depending. So I wonder if we should look into further months. Is prop track a little bit more finger on the pulse, whereas there's some maybe a little bit more data veracity, but it's delayed from core logic? I'm not going to call it Cotality or whatever the bloody hell it is. I just finished calling it RP data,
Yeah. Well, what's interesting with the new Cotality report now is in the current or the new format, they show prior revisions, and so they'll demonstrate, and they call it vintage. So what it was recorded at and what the figures are now telling us for that month, the review mirror revision version. And there is a discrepancy, which means that data collation is delayed.
That's really good to hear. So they're actually going, okay, now we've got all the data for that month in, we'll change the numbers for that month.
Yeah, a little bit like our auction clearance results when we get them adjusted after Saturday night or Sunday. Yeah,
have you got
it is
an
good
example?
to see.
Have you seen a number where you can go, look, so for example, Melbourne was 0.4 2 months ago. Now they're saying 0.6 or anything like that. Have you?
Yeah,
been able to get into
absolutely.
that
So if we
detail?
just, I popped it in our notes as well, which I'll share in the show notes. Melbourne, for example, I mean, it's a little bit harder to tell because it's 0.2% and then 0.1% for April. But, ACT 0.4 versus 0.2, that's a big margin of difference. Darwin 1.1 versus 1.3.
So it
revised
they
up.
moved it.
Is that right?
Up?
Yeah, so with this new chart that we've got our hands on with Cotality, they're showing us a month later what the previous month's adjusted figures are looking like, and some of them are greater variations than others. For example, Melbourne's only been adjusted by minus 0.04%, which is a tiny blip. But if we have a look at rest of Tasmania or rest of Northern Territory, for example, they've been adjusted substantially, 0.41%, 0.51% respectively. So what this is showing us is they do have a grip on the data and how it signals a change in information a month on. And I also wonder what it would look like 2 or 3 months on if we're dealing with long settlements.
Yeah, that's what I was thinking about. Do you know, we should do an episode on actually unpacking how CoreLogic's hedonic index works and then try to sort of explain it to our listeners in layman's terms, because it is quite complex. I know Christopher Joy was a primary person creating their hedonic index. I'm not sure if you two knew that. And then look at, for example, how PropTrack realestate.com.au's works, and then look at, what are some of the potential strengths and weaknesses of each of their, we don't know for sure, do we? We assume this is because sale prices come through delayed.
Yeah.
And then, so therefore, as you just said, you would expect there would be more changes multi-months down the track, which just goes to that point of, the data isn't necessarily all the information when it's being shared at the end of a month with everybody. And it's also why, as I've said, at times I feel like the more simpler indexes potentially show the changes in price values sooner, although in this instance it would. So that, I think, probably applies to Melbourne, whereas PropTrack has had Melbourne as a leading growth capital city for the month just gone at 0.8%. But then again, Darwin is well below on the PropTrack one, so that sort of puts into question that theory.
Yeah.
So what's the takeaway for people listening to us kind of look at the nuances of the data? I suppose in some respects, whenever you try to measure something and report on it, you have to make decisions. I mean, what we do in our business in analyzing our data is obviously a much smaller level than this. But like, say, for example, some of the data points, like the distance between where people buy their investment property and where they live, we've got options to say, okay, well, are we doing it as the crow flies, or are we using like a Google Maps API integration and figuring out how much it would cost to how far it is to drive? And then maybe that's different in peak hour. Maybe Google Maps actually suggests a different route that is more kilometers because it's going to be faster. Like, that's just probably one little example. And I think if we're comparing CoreLogic and Price Finder, you can go down to the next data level that a lot of property investors use, things like HTag and Suburbs Finder and DSR and all those sorts of ones. I've spoken to buyers agents before, and they've reported that, vacancy rates, they have a slightly different methodology per service. So it just kind of goes to show that there's going to be differences depending on where you're looking. And at the end of the day, you can't buy the Darwin median anyway, but when you are trying to understand things, you should understand that there can be variances in the data. I mean, that's my best read on the value of this conversation. What do you reckon?
I also think that we've got to remember what this growth is measuring. It's not measuring every single dwelling that's growing. It's measuring the rate of change of the median value. Now, if we've got initiatives or incentives or, just a clear mandate from a massive cohort of buyers agents in one smallish city to go for a certain price point. And you've said it yourself, Mike. I remember you coming to me during COVID saying, what's going on with Melbourne? And we just had a state-based initiative with stamp duty, a 50% discount for everything under $1 million. And so that segment of the market was soaring. I think we've got to keep that in perspective. A lot of these really active investors aren't targeting Darwin because they're spending $2 million. They're targeting Darwin because they can get a house for 500 and something. And the yields are really good. So, and we all know that in most cases, the less you spend on a property, the greater the yield will be as well. So Darwin's seen enormous pressure on a pretty tight segment of the market.
And the lowest quartile too, right? So in a sense, you could have the Darwin property market kind of pumping, but the median dropping because the segmentation shows that it's only the cheapies that are selling. And if you keep posting a cheapie sale, then that median could actually drop if there's no turnover at the top end of town. But I remember that conversation with you really vividly, Cate. I basically said like, why is Melbourne
What's wrong with
tanking?
Melbourne?
And you're like,
We're
you
not
don't get it,
tanking.
man.
Yeah. But I think it's also, for example, the Hedonic index picks up those sort of things and factors it in because it considers the number of bedrooms, etc. So it isn't as easily distorted as some others where if the bottom quartile was selling most, it might drag down the median even though those values are going up. Look, I would, we've covered this actually in an entire episode, and why I'd always recommend to our listeners to go back and listen from the start to all our episodes. We spent a whole episode on unpacking how to consider data, and the title had a name within it of lies, statistics. And I reckon it was around episode 20 or 30. And, part of the point is that, data isn't the panacea, because data itself isn't accurate. It's still someone's way of thinking about things to, that then ends up with a number that then you need to make a decision upon. And that number isn't perfect. So, go back and listen to that episode. Anne-Marie will share it in the related episodes at the end of this episode. But what I would say in terms, if we're back onto, okay, what's happening across our capital cities, and this goes to the episode we just put out there in terms of what happens to the Australian property market when interest rates are falling, is that historically prices across the board go up. And that's my take on what's happening at the moment. Every single capital city has prices rising. The three capital cities that have boomed over the last 2 to 3 years are actually starting to pick up a little bit of pace again. And so I think that's what's happening now. And I think, we're in the early stages of a reasonable run in the property market. So that's that. If instead of, going 1.7, 0.6, etc., I think there's opportunity out there for buyers would be my take.
That's a very good observation, Dave. I spoke to Terry Ryder last week, and he made two observations that I want to share. One was that you can get, if you torture data, it'll tell you anything you want. I thought that was an interesting insight. Obviously, he's tortured quite a lot of data over the years. The other thing is that he believes that there's going to be a lot of second wind markets. So markets that have performed reasonably well in the past sort of 5 years that have had a little bit of a breather. That's where he sees some opportunities. And you're right, Dave. Like we've got 3 of the 8 capitals at the peak, which is really just the Brisbane, Adelaide and Perth. They're on the decline, but they're still actually growing. The pace of growth is slowing, but of course, if it grows month on month, it's still peaking, right? We haven't hit the peak for those markets, but yeah, for the others, I mean, you've got Sydney and Melbourne that is 0.3%. Sydney behind from the peak. Melbourne's 4.5. It's still got a way to go. Darwin's close. Canberra's still 6.4% down, and Hobart's the real outlier at 10.5. But yeah, we do have every single capital city providing a growth print for the month of May.
Yeah, and even with where you say, look, the rate of growth is slowing for those big 3, Adelaide, Brisbane, Perth, it's picking up again. So the pace has actually picked up this month for all 3 of them. To that comment, and that's something I've noticed as well, to that comment, what was his description? It's a good way to describe it. They're getting a second breath of wind second wind. Yeah, and I think, like if you've got imagery of someone blowing, a balloon sort of come down and someone's blowing it back up again. That's sort of, what's happening, and the interest rates, 2 interest rates falling, and the markets as of a couple of days ago had 97% likelihood of another rate reduction by the RBA in July. So, that's breathing life into all all capital city property markets at least.
Yeah, you're absolutely right. And just back to some of these, one of the 3 that you mentioned, Adelaide, I'm still in awe of Adelaide. The prop track data suggests that that's had 11% annual growth, which is the first one to crack double-digit growth figures for a 12-month period.
Interesting.
Yeah.
But you do wonder, like a second wind for Adelaide when its median value is at 829 compared to 791 for Melbourne. I know it's not a great thing to do, is to compare the medians against each other, and therefore Melbourne has to go up or Adelaide has to go down because it traditionally sits at a percentage. But it's a data point. Me wonder.
It is just a data point, and what's really important, which we've said many times, is having a look at the house prices as opposed to dwelling values, because it's got Melbourne pretty close to sharing second place with Canberra, which is not what the median dwelling data is telling us. Our house price data is quite different.
Yeah, that's right. Actually, Brisbane I've got some median values here for CoreLogic. Brisbane's just broken 1 million for houses for the first time. Canberra's at 975, Melbourne 939, Adelaide 882. But look, I'm tend to be like you, Mike. I just think Adelaide's most at risk with what it's done over the last few years, and the fact it's still got the highest according to PropTrack over the last 12 months. It's probably where I'd be least wanting to put my money in terms of out of any of the capital cities.
I also spoke to Mr. Kalizos, the professor himself, last week, and he said, obviously he's Mr. Adelaide. Like the bloke could be mayor and no one would be disappointed. He loves the place so much, but he's been surprised himself and noted that the the activity of the buyers agents that came in, and many of them probably were overpaying, has created quite an influence on the market, and it's outperformed even his expectations. And he is always glass half full when it comes to Adelaide.
So
Yeah.
if
That's
Pete's slightly pessimistic, probably the word frothiness comes to mind with the market.
All right, well, let's move on, and we've got some fresh new data on rents, and it's an interesting little slippery dip. However, Hobart's had a little lump in the last little while. Units and houses behaving a little bit differently. Who wants to start on this one with observations?
Yeah,
I don't mind. You go, Dave.
Well,
A good host would say, Dave,
choose
what do you
one."
think? Instead of letting you talk.
Yeah,
over
which
each
one of
other.
you want to have a crack?
Oh, I should get fired from this.
Look, I've got a couple numbers here. So the monthly pace of rental growth has eased back in May nationwide. So back to 0.4% following 3 months of 0.6% month-on-month gains. Now, that often can be seasonal. Early in the year, you can see rental growth be more rapid as people tend to be moving properties at the start of a year, but it's fallen back. But with a few exceptions, as you've just noted, Darwin and Hobart rental growth has accelerated.
It's interesting, isn't it? With Darwin, it was a similar thing with Perth for a while. So many people were buying in Perth, yet the rents were staying super robust. And I presume that there's a hell of a lot more investment properties in Darwin today than there was maybe 5 or 6 months ago. But yet we see the rents increasing. I wonder what that is. I mean, do the new investors come in and they're trying to maximize the rent? Maybe if it was an existing rental property, it was suboptimal, because we know that,
I think so.
If houses don't turn over, rents tend to stay under
Lag.
market. You need that turnover to actually catch up. But I don't know, Cate, is there another explanation?
I don't know either. I mean, each time I look at this chart, especially Hobart, it's dancing all around the place. I think that the discrepancy between houses and units needs to be noted. And Hobart, I would argue, has a different ratio of houses and units. And Dave, your data would certainly qualify this claim for me, because I'm not looking at data. I'm just very familiar with Hobart, and there are less units in that city as a proportion of total housing than what you typically see in other capital cities. So have we got an influx of people that are price capped and they just want units, and there are insufficient units in Hobart? I don't know. That's my best guess.
That's a good point. So I've got that on hand every week. So Hobart only has 18.3% of its total property as units. And that's actually reduced since July 2022. So they're building more houses than units there. It's gone down from 19.4%. And actually, that's the same with every capital city. The percentage of properties that are units has reduced between 2022 and 2024, just to feed into that supply issue story that we have. But then,
It's typically urban sprawl as well. So if you've got, a city dweller who is, on secondment or on contract and not wanting to commute from the burbs into the city and just wanting a unit that's nice and close, they'll pay more for it if there's less available. So I think that's what I'd be circling. Australia's had a real love affair with houses, not units, over the last couple of decades. And are we seeing a swing back to the city? Are we seeing a heightened demand for units? Well, this data would definitely suggest that.
I don't want to argue with that because I suspect that it's true, but I want to throw something else in the mix. Every single capital city has faster growing rents than in units than houses. And now Dave highlighted, well, supply is constrained, but I don't have the data on this, but I presume that unit rents are cheaper than houses pretty much across the board, and most capital cities at least. We've seen the pace of rents drop in 2025, yet it's not like there's extra supply. In fact, there's an argument to say there's a lot less with immigration. Is this actually people adjusting to the pressure? Because that was my one prediction this year that I'm hanging my hat on, because I probably got the rest of them wrong, is that rents wouldn't grow as fast, not because there's more supply, but because people are hitting their ceiling on their maximum affordability, so they'll change their behaviours. They'll have, a roommate, or they'll bunk up with other people, and maybe selecting a unit rather than a house is part of that cost saving.
I think so.
I think that's part of it.
Makes absolute sense that people are going, look, a house is too affordable, more willing to live unaffordable, more willing to live in a unit, and then that's putting pressure on rents for units. And as I've just shared, every capital city has less units. So, and if there has been less demand for them, that would have kept prices down for longer. Therefore, the disparity between a house and a unit will be larger than perhaps it historically was, which is something, we shared in the chart in terms of certainly the correlation between values of houses and units, becoming that relationship, houses becoming more and more expensive relative to units over the last 40 years in the recent episode we just did live. So, you think that would play out when it comes to the rents as well. And so maybe they're playing a bit of catch up at the moment.
I've got another theory, and that is the impact of work from home being abolished for some workplaces. And where people previously needed more space, they would have had a house with an extra study. If they're being called into work, first, if they're renters, they'll be saying to themselves, well, I want less of a commute. And secondly, I don't need the third bedroom or the study. That might have impacted a swing towards units that are closer to the workplace.
Yeah.
Yeah, I think that adds to the tapestry of all of those points that I think they're probably in different weightings all correct, that reach the critical mass of what we're seeing in the data. I like that. I mean, this is a real good, we should have had a bottle of wine conversation for these thought experiments. And
I'll switch it up from AM to PM if you buy.
Do one episode with this
drunk property.
Yeah.
We'll have to. And I mean, like Dave even sort of said before that I made perfect sense. I mean, it's not often you get a high compliment from
That's
from
pretty
Dave
cool, isn't it?
like that.
Just even if we come back to your point, which we sort of drifted away from, but I think that makes sense as well, what you said about Darwin and the fact that prices are rising rapidly, but so are rents. And why is that? And you'd think it is because there's new owners readjusting the prices of the rent for new tenants. And, sometimes they're going to be buying owner-occupied properties that weren't even rented, and now they're coming onto the market. So there's these new higher valued rents that hadn't previously been rentals. So that's going to push up the notional rental levels for that capital city. I think the other one is often, you get people who'll buy a house, they'll then do some smaller renovations before renting it out as well, which will boost the rental income also. So I think there are a number of factors why you do, it's sort of counterintuitive, but when a property market prices are going up pretty rapidly, you often see the rents rising as well.
It is counterintuitive, but we saw it in Perth, and I can remember every month going, I don't know if I understand why. There's so much supply coming on, but I think that's the best answer I think we can come up with. Let's change gears. Let's go listings. And I'm very interested in another thought experiment when it comes to listings, and maybe I can give you guys a bit of a challenge. Could we potentially pick the bottom of, say, Hobart or Tasmania, looking at just these listings? Because if you look at the old listings greater than 180 days, I mean, Hobart's had a 33% increase over the year. But when we look at the month of May, distressed listings is down 2.5%. Could that be the first indicator that it can't go much further down? Because it is the most depressed, saddest market in the world, which coincides with the political sadness of, I mean, I don't know the ins and outs of it, but a vote of no confidence in the Premier is probably not the thing to put the spring in your step as a Tasmanian.
I don't know, because the figure isn't too far off that of Sydney if we compare both of those metrics.
True.
I think the data in listing activity does certainly tell us a lot about peaking markets and markets that are being, in high demand from buyers, especially the old listings data. Distressed listings I've always kind of queried because the numbers are so tiny.
Yeah.
Yeah, I tend to be the same with distressed listings. The numbers are so small, they can jump around a little bit. But I do think that bigger picture of reading the listing numbers and the trajectory they're going on across total, new and old can give you a pretty strong picture on its own of the direction a market is heading.
Well, let's backfill for something that we know is true, and that is Darwin is growing its median price. Even doesn't matter which data house, they're both saying it go up. But if you look at old listings, which is a much bigger sample than distressed listings, although still limited, Darwin has dropped 46% drop in old listings over the year, which is absolutely massive. And for the month, it dropped another 2.1%. So old listings tend to get hoovered up in hot markets. And Brisbane is down, Adelaide is down, but Canberra is up 58%. And Canberra is, I mean, it's probably fighting Hobart for one of the saddest markets as well.
Well, I was a little bit intrigued by Adelaide in this one. If we have a look at the monthly change for old listings, 16.5% is a lot. That means for the month of May, that percentage figure represents the number of old listings that weren't snapped up compared to the month prior. And I just wonder what's going on there. Is it just a blip? I mean, it was a difficult month because we had Easter and then the election and the aftermath of that. But that was an interesting figure considering its annual change is pretty close to zero.
But it's sort of the data number that could be a signal in the beginning of a trend that suggests a market's reached its peak. Yeah.
I think if we see 3 months of double digit, yes.
Yeah.
It means the uptake appetite is far less.
Yeah, and if we see then the yearly change, it's at minus 3.3, but if you then see that going to positive and keep creeping up in that greater than 180 days old listings, it's a real price signal, isn't it, that Adelaide is hitting a peak and under pressure.
Perth as well, we've got 11% increase in new listings in Perth. Nowhere else in the country is in positive territory. So that's an indicator that the peak of the market is close. Maybe it has.
Well, the vendors are a bit late.
Yeah, the vendors are definitely a little bit late. And, Darwin, 28% less total property listings year on year. I mean, that's an indication that it's probably going to be running for quite some time.
Yeah. It's the early stages of a big run. And, I think there's a big chance we'll see 20% growth across a 12-month period at some point for Darwin.
Did anyone put that in their top threes as a wild card for predictions for 25? I don't know. I don't know if anyone.
I think I did at the start of 24. And then
anyway, all your predictions are for 2026, Dave. Like, that's your year.
Yeah. No, I certainly didn't.
What about sentiment? Cate, I'm going to throw to you because that stops you guys talking at the same time, which is a bad way to host a podcast.
You know what? It wasn't a massive change this month. I had a look at the data and I thought, okay, this is, what did you say a while ago, Dave, an anemic kind of response, considering all that we're going through, all of the global tensions and stock market uncertainty and, just changing parameters constantly. And also knowing that from an inflationary pressure point of view, we probably are in store for another interest rate cut. this chart didn't dance around like I expected it to.
Yeah, I think there was a little brief period post that last rate reduction where there was talk that the next one might be a fair way off. And I wonder if this survey was done at that point in time before now it's back at the point, I think, like interest rate expectations, I think would be much higher if it was asked now than when this survey was done, which was probably a week or two ago. I mean, time to buy a dwelling index keeps creeping towards 100, which I've said I believe that's going to keep happening. It's going to get above 100 in the near future. So that just crept up from 90 to 93. And that I can't remember how low it was down, but I think it was like in the set. Yeah, so like it's been down in the low 70s. So I think that's going to keep rising, particularly off the back of the rates falling. Probably the main mover was a house price expectation index, which jumped up 155
it's wacky,
to
isn't it?
166. So people just go lower rates, higher prices, I think.
And what they're saying is we know house prices are likely to go up, but we still don't think it's time to buy one. So I wonder what they're waiting for.
Yeah.
Green shoots.
That's right. Yeah.
And we've had an increase in the toys, major household items. In fact, that's been the biggest increase across the board, the biggest change. Ticked up from 93.2 to 100. Now, there's also a little bit of information floating around at the moment about our rate of savings, our comfort levels around our own savings, household savings, and this one probably goes hand in hand with that. People are feeling like they've got a little bit of insulation around them financially and they're more comfortable. 100.2% signals a very balanced market when it comes time to buying toys.
Let's dive into that, Kate. The household saving ratio has increased. What are the numbers telling us there?
Yeah, so our household savings ratio has increased. It rose to 5.2% as growth in gross disposable income outpaced growth in nominal household consumption. So in other words, we've earned a bit more than what we're spending, and this has been a bit of a turning of the tide.
Yeah, so I think off the back of the rate rises that occurred to try and match inflation, and we know a number of those are still flowing through to lower income earners and public servants, member of unions. I read an article on it recently. So it's actually now starting to outstrip inflation, the rate rises that have been locked in for a number of years. And so, I think that's flowing through here, isn't it? And it also needed to reverse, really, because we had such a high level of savings during COVID, and then everyone's been spending it all and depleting their savings since then. So this changing of the tide was probably somewhat overdue, as you said.
Dave, give us a quick lowdown on lending at the moment. We've got slightly older data, but we can still see quite a bit of activity amongst all cohorts, but some interesting jumping around here and there.
Yeah, so the March quarter 24 to March quarter 25, probably the standout is the investor numbers growing at 8.8% change versus upgraders at 6.1 and first home buyers 1.3. So they are, investors are certainly seeing opportunity over the last 12 months. I mean, if we look over the last quarter, everyone's in negative at about a similar level, around negative 3 point something to negative 4 point something, which I'm not sure if that's just seasonal or if that was people have certainly been, and we've seen it on the ground in our business prior to the first rate falls, people were certainly keeping their powder dry, and now people are starting to make decisions much more easily, if you like, and with a bit more sense of urgency. So maybe that's what had played out in that first quarter while people were keeping their powder dry for for the first rate reduction.
And you've highlighted a little bit of a blip when it comes to average loan sizes for investor dwellings, or was that one of yours, Kate? I think
Yeah,
that's
that
an
was one of
arrow of
mine.
yours.
It is indeed. I like my arrows. I liked segmenting the average loan sizes for investors by state. And when we have a look at the Northern Territory, it's a really obvious uptick in loan size. And in a sea of everything that's either linear or slightly declining, it was a little bit of a surprise. You can spot it straight away on here. It says that investors are spending increased amounts of money in the Northern Territory.
Which I guess with what's happening with the Darwin market correlates entirely.
That's right. Now, are they responding to competition and getting their hands on more money and fighting harder for the same product? Or are they targeting better quality houses than previous investors are? We don't know that yet, but segmenting the price points in Darwin will certainly give us that insight.
The 3-year bond yields data, Dave, we've seen that sort of track back a little bit, which kind of highlights the expectations that interest rates will be a little bit lower, but it hasn't really done much at all. In fact, it's been somewhat flat for a little while. What can we read from that?
I think just with that global uncertainty, people aren't sure what's going to happen in the long run. People are worried about tariffs and the consistency of Trump's decision-making and approach to his presidency. So
Taco.
I think, what's
Love him
taco
or
stand
hate
for
him,
again?
you'd have to concede that his consistency is not one of his virtues.
He's consistently inconsistent.
Yeah, sure. Unemployment, 4.1%, same as April. I mean, there's a lot of people. I don't know if you remember Tim Gurner coming out and maybe injudiciously talking about how interest rates had to go up and how, heaps of people had to lose their jobs, which is always hard to hear from someone with hundreds of millions of dollars of backing.
Yeah, it's a very hard one to talk about. When you're talking about which levers need to be pulled, and you're actually talking about jobs and people's lives, it's definitely a case of how it's delivered and who delivers that information. But I think broadly, everyone's been anticipating that unemployment will creep up, and it's actually been quite consistent and has really defied what some people said would take place. So it is a case of watch this space, though.
When we get to our GDP figures and we look at different industries, agriculture, forestry and fishing has been hammering along for quite some time. And I don't know if you guys have the insights into that, but I'd like to understand exactly what we're talking about there. I was listening to a podcast yesterday and there was an observation that China domestically produces about 40% of the calories it needs to feed its own people. And I thought that is an interesting one. And I'm sure that is something that military tacticians and strategists understand, because, we're all dealing with global powers that have strengths and weaknesses. And, the snow globe of the earth has been shaken up in the last little while. Is there more to it than that, or is it just a sector that, like we have been described as the food bowl of China in the past? Like, what else is going on there?
Well, I suspect that's a big part of it. We're a big brown wide land with lots of minerals to dig up and agriculture to farm and grow and share around the world, and oceans all around us to fish and do the same thing. And I think, I've equated it to one of the best land to asset ratio countries in the world a few times over the journey. And I think, we're very like that. One of the things that really feeds into Australia's prosperity. It would be nice to dig into the numbers in a much more depth. Perhaps there's an episode in that.
Mm.
And I think, on some level, some of what you've just talked about feeds into what's happening in Darwin and its strategic importance, and why the federal government is pouring more money into Darwin than any other capital city per capita by a significant margin more. And that's possibly also somewhat of what's playing into why the rents are rising as well as the prices in Darwin, just as a slight tangent that sort of interconnects some of those thought pieces that you were just talking about, Mike.
It's an interesting one, and I think the strategic location of it is crucial, right? And if we are going to defend the country, I mean, the attacks aren't going to come from the bottom. Although we did see that Chinese ship. I'm not asserting that China's about to attack Australia, but they came down the east coast and did some live firing, and Australia didn't know about it until I think it was a Jetstar captain raised the alert that, there's missiles sort of going up through the airspace here. And I think that ship did actually go past
All
Adelaide and down the bottom.
Circumnavigated Australia, came across the bottom.
Interesting. They love a bit of posturing, don't they?
They do. I mean, if you think about how small the population is in Darwin relative to the country, well, I won't extend on that thought. But
I was just trying to give you enough rope, Dave, and see what we can do.
The China's army is probably significantly larger than the population of Darwin in its entirety.
Yeah, without a doubt.
We've always needed friends. There's just, I mean, as sophisticated as our forces are, I mean, amongst the highest trained people, there's just not enough. It's not enough people to defend a continent, let alone, a landmass. Anyway, any other takeaways from you guys?
I'm sure there would be, but that's as good
on
a
the
time as any.
GDP data.
Just in general.
Make it
if I circle back on the GDP data, I remember when we had supply chain woes and transport was up there, and how quickly things calmed down. We had that, what was it called? The Freightos Baltic Index. Yeah. And I could not believe what I was seeing in terms of the cost of freight and just the complexity that we were dealing with in the aftermath of COVID. But yeah, here we are 5 years on, and that transport figure is down close to zero.
All right. Gold nuggets?
I don't think we do them for market updates, do we?
We don't do them, do we?
No.
Nah.
Jamie, we're really sorry about this.
Let's get into our next episode, hey?
Yeah.
All right, I'll wrap it up. All right, well, that was the month that was, the May data. Some really interesting things to observe with 3 of our markets still at the peak, 3 of the 8 capital cities, Darwin going through the roof, Melbourne yet to sort of scream out to us in the data, but anecdotally it's happening on the ground and we're waiting to see that, and a couple of thought experiments about data and maybe an attempt for us to pick the bottom of the Tasmanian market in the next couple of episodes. But
it might be screaming out to us in the prop track data.
Yeah, there you go. And we may need to have Anne-Marie come in and share the previous episode that shared some of the insights into how those indexes work. But rest assured, we'll be watching it month in, month out, and downloading all of the data and our insights for you in this monthly update. So we'll see you for the next episode and the next update. Thanks, guys.
See you next week.
See you later.